Maybe you are looking to invest in the China market, but you are super confused with all the terms that's being thrown around, like what A shares lah, what B shares lah, what A shares lah, ADRs lah, and on top of that, there's a ton of China ETFs that you can invest in. Which to choose so? That's why in this video, I'll be covering everything you need to know about investing in the China market, such as what are the different types of share classes, which are the best China ETFs that you can invest in, and lastly, I will share some suggestions on which one you should go for. As a bonus, I've compiled all this info into this super detailed spreadsheet, which you can download for free, link down below, yeah? Also, do join my 8,000 members Telegram chat group to discuss or ask any questions that you may have. Okay, let's quickly talk about the types of China share classes that you can invest in, so that you don't blur later on. The bad news, they have a whole bunch of share classes, even more than the amount of Chai Fan dishes that my Chai Fan auntie sells. The good news, you only need to know 3 main share classes, namely A shares, H shares, and ADRs. Dr. Wealth has this fantastic image which explains what's going on. A shares are shares that are listed on the mainland China stock exchanges, such as your Kuaizhou Moutai, Ping An Insurance, and China Merchant Bank. Meanwhile, the word H in H shares means hentai, I mean Hong Kong. So there are shares that are listed on the Hong Kong Stock Exchange. For example, your Alibaba, Tencent, and JD.com. Lastly, US ADRs are China shares that are listed on the US Stock Exchange, like Trip.com, Baidu, and NetEase. The main difference between these share classes is the accessibility. For example, A shares are generally only available for China citizens, and foreigners can't easily invest in them. On the other hand, H shares are accessible to all investors, but because they are denominated in Hong Kong dollars, some investors prefer to invest in the US ADRs instead, which are a lot more accessible. However, because US ADRs are not exactly company stocks, they come with their own disadvantages. Alright, now that you know the basics of China share classes, we are now ready to talk about which are the best ETFs to invest in the entire China stock market. The first 3 ETFs, MCHI, ICHN, and 2801 are tracking the same MSCI China index. This index includes 700 large and mid-cap companies, which are A shares, H shares, and ADRs. The top 3 sectors of these ETFs are consumer discretionary, communication services, and financials. So this would be a little similar to the S&P 500, which also tracks the largest companies in the US. Most of the top holdings are familiar names, such as Tencent, Alibaba, Pinduoduo, and Meituan. The 4th ETF is YYY, or Lion OCBC Securities China Leaders ETF. This ETF only tracks the largest 80 Chinese companies that are listed in the mainland China and Hong Kong stock market and are eligible for the Stock Connect schemes. The top 3 sectors of this ETF are financial, consumer discretionary, and consumer staples. And again, the top holdings are familiar names such as Tencent, Kuaizhou Moutai, and the China Construction Bank. The unique thing about this ETF is that since it's listed in the Singapore Stock Exchange, you are able to use your SRS money to invest in it. So which ETF should you go for? Out of these 4 ETFs, MCHI is the most popular ETF as it has the highest average trading volume of 4.37 billion shares a day. However, the downside is that it has the highest expense ratio of 0.59%. So a better choice would be 2801, which has a much lower expense ratio of 0.2%. Moving on, the best ETFs to invest in China A shares. By the way, if you're wondering why would someone invest in just China A shares, here are a few reasons. 1. China A shares have low correlation to overseas markets. This could help to provide diversification to the portfolio. But perhaps the more important reason is that China A shares are relatively under-researched, while at the same time have improving valuations. Hence, some analysts feel that they might deliver higher returns over the next 10 to 15 years. First, we have 2823, which tracks the 50 largest A share companies in China and is heavily focused on financials at 30%, consumer staples at 27%, and industrials at 11%. So if you are looking for an analogy, this would be similar to the Dow Jones, which also focuses a little more on financials and industrials. While you may be a little unfamiliar with the top holdings as you may seldom come across them, but they are some of the biggest and most important companies in China, such as Kuaizhou Moutai, which produces and sells alcohol, Contemporary Amperex or CATL, which manufactures batteries, and China Yangtze Power, which is the largest power utility company in China. Next, we have 2846, which tracks the 300 largest and most liquid A-share companies. The top 3 sectors are financials, industrials, and technology. And lastly, we have CNYA, which tracks the inclusion of A-shares in the MSCI Emerging Markets Index. This ETF has 520 holdings, and similarly, the top 3 sectors are financials, industrials, and technology. Out of these 3 ETFs, the most popular ETF is 2823, which has a 6.57 million average trading volume. However, a better choice would be 2846, as it has a much lower expense ratio at 0.16%. Quick pause. Did you know that Webull has one of the most competitive pricing on the market? For the US market, during regular and extended hours, they are only charging a very low fee of 0.025% of the trade amount, with a minimum of just 50 cents. And for overnight hours, they are charging 0.03% of total trade amount with a minimum of 89 cents. For the SGS market, they are also charging a low fee of just 0.05% of the trade amount with a minimum of $1.60. Or if you are a new user, you get to enjoy commission-free trades for SG stock trading for 3 years. For the Hong Kong and China market, where they are charging a super low 0.02% to 0.03% with a minimum of 12 Hong Kong dollar or 12 renminbi. And if you are an US options trader, you'll be glad to know that Webull is just charging 55 cents per contract with no minimum fee. Besides the low fees, for the US market, Webull also supports US fractional shares, which means you can start investing with as little as $5. And for the Singapore market, Webull supports odd lot orders, which means instead of having to buy a minimum of 100 shares, you can just buy 1 share of eligible SGX stocks. Webull is offering upsized promotions in May. With Webull's latest welcome promo, they have launched a new reward called USD Moneybull Interest Booster. For my viewers who use my exclusive link to sign up and fund, you can get up to 8.4% USD Moneybull per annum yield, capped at $250,000 for 180 days with estimated return up to $10,500. This figure is computed based on the 7-day yield of the USD cash fund in Moneybull as of 25th March 2024, plus the Moneybull interest booster generated after 180 days from the first $250,000 Moneybull subscription. Besides that, you will also get up to $1,050 worth of cash vouchers when you fulfill the requirements. This promo is for new users only. But if you are an existing user, good news! If you have not participated in any Moneybull promos before, you will get to enjoy a 3% bonus on your net cumulative deposit when you deposit fresh funds of anywhere between $10,000 and $250,000. Subscribe at least $10,000 to Moneybull and maintain both your fund balances and Moneybull activation until 31st August 2024. Lastly, there's a new transfer-in promo, from which you could get up to another $2,000 worth of cash vouchers, plus $500 trading vouchers by fulfilling the promo requirements. This is exclusively eligible for both new and existing users who sign up with my link in May and have not transferred shares in before. So if you are interested in trying out Webull, do sign up to them using my link down below. And with that being said, let's get back to the video. Moving on. Oh, the next list is an exciting one. The best ETFs to invest in the China tech companies. First, we have KWEB. This ETF tracks the CSI Overseas China Internet Index, which is pretty self-explanatory, yeah? China Internet means China companies which focus on Internet and Internet-related technology. Overseas means the stocks are listed on either the US stock exchanges or the Hong Kong Stock Exchange. This ETF has a rather low 33 holdings, so it's pretty concentrated, and it heavily focuses on consumer discretionary, communication services, and industrials. Unsurprisingly, you would have heard of most of the top holdings, such as Tencent, Alibaba, Meituan, Pinduoduo, and so on. So the US equivalent would be the QQQ ETF. Next, we have CQQQ, which tracks the performance of the large and mid-cap tech companies in China. This includes your A shares, H shares, and ADRs. This ETF has 155 holdings. The top 3 sectors are technology, communication services, and consumer discretionary. And again, the top holdings are all your popular tech companies. The last 3 ETFs, 3067, 3032, and HST, all track the Hang Seng Tech Index, which represents the 30 largest tech companies listed in Hong Kong. The top 3 sectors are heavily focused on consumer discretionary, communication services, and technology. Out of these 5 ETFs, KWEB is the most popular ETF, with an average trading volume of 21 million shares a day. However, KWEB has 3 major downsides. 1. It has the highest expense ratio of 0.69% out of all the ETFs here, so you would be paying more in fees. 2. This ETF is domiciled in the US, so you will get slapped with a 30% dividend withholding tax and up to 40% estate tax when you pass away. And lastly, some of the holdings are ADRs in the US. As mentioned earlier, ADRs are not company stocks, and there's a risk of the US delisting ADRs from the stock exchanges due to regulatory issues. So if you want to invest in China Tech, the better choice would be to invest in 3067, which is listed in the Hong Kong Stock Exchange. This means there's no dividend withholding tax if you are from Singapore, no estate tax, and more importantly, the holdings are all H shares, so you get to own the actual shares. And oh yeah, the ETF has the lowest 0.25% expense ratio, which is pretty nice too. However, if you are looking to invest your SRS money in China Tech, then you would have to go for HST. Last but not least, we have the best ETFs that track the Hong Kong markets, aka H shares. The first ETF is 2800, which tracks the largest companies on the Hang Seng Index. Currently, it has 82 holdings, and the sectors are heavily focused on financials, technology, and consumer discretionary. Most of the top holdings are familiar names, such as Tencent, HSBC, Alibaba, and Meituan. The second ETF is FXI, which tracks the largest 50 companies listed on the Hong Kong Stock Exchange. Fun fact, this is one of Ray Dalio's favorite ETF to invest in the China market. The top 3 sectors of this ETF are consumer discretionary, financials, and communication. And once again, most of the top holdings are familiar names. Among the 2 ETFs, the cheaper one to go for would be 2800, as it has an incredibly low 0.08% expense ratio. So those were some of the best China ETFs that you can invest in. But I guess the question now is, which should you go for? I would say if you are new to China and you just want to get exposure to the China market, then perhaps a broad-based China ETF like the 2801 would be great. With this ETF, you get to invest in the top 700 large and mid-cap companies from China. But maybe you already have some China holdings and you are looking to increase your allocation in the domestic China market. Or maybe you just want some diversification. In that case, you can check out the A-share ETF, specifically the 2846 ETF. Then maybe you just want the high growth potential from China tech companies. If that's the case, you can invest in the 3067 ETF. And lastly, if your goal is to invest in China, but at the same time, you don't need to invest in like 700 stocks. In that case, you can invest in the 2800 ETF, which only tracks the Hong Kong market and has only 82 shares. Anyway, that's all for this video. Hopefully, you found this useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.